We're looking live at Beyond Meat, trading on the NASDAQ under ticker symbol BYND. And the picture this morning is not a pretty one. As of 9:52 a.m. Eastern Time, the stock is trading at just 1.18 USD, down about 0.88% on the day. The intraday chart shows the stock opened at 1.18, spiked to 1.21, and then fell to a low of 1.15 before clawing its way back to this 1.18 level. This is a company with a market capitalization that has now withered to around $836 million, and it is trading perilously close to its 52-week low of just 50 cents. The 52-week high of $7.69 seems like a distant, impossible dream from another lifetime. But the real story today, the insight that is being missed by just looking at this daily chart, has nothing to do with today's 1-cent drop. The entire foundation of this company's stock has been fundamentally altered in a way many retail investors may not have fully processed. The company just confirmed a massive, almost incomprehensible level of shareholder dilution. The common belief, the expectation, is that Beyond Meat is a beaten-down meme stock, a high-growth name that got hammered by inflation and competition but might be coiling for a massive short squeeze. We just saw news break a few days ago, on November 4th, that the company is partnering with Hard Rock Cafe to get its new Beyond Burger IV into all their North American locations. This followed news of expanded distribution in Walmart and new product packs in Canada. This looks like a company on the offensive, fighting back. That is the expectation. But the reality is that these are small wins that are completely overshadowed by a financial situation that can only be described as desperate. The reality is that Beyond Meat just announced it is delaying its third-quarter earnings report, originally scheduled for November 4th, pushing it back to November 11th. The reason given is that the company needs more time to quantify a material impairment charge. In finance, words like material and impairment are massive red flags, signaling that the company is about to write down the value of its assets, acknowledging they aren't worth what they thought. This news, combined with the company's preliminary results, paints a grim picture. Revenue is expected to be around $70 million, which is a continued decline from the $81 million it posted in the same quarter last year. Gross margins are razor-thin at 10 to 11%, and that is before accounting for the costs of completely ceasing operations in China, another market where the plant-based dream has failed to take root. But even that is not the main story. The most critical event, and the one that explains why the stock is at 1.18, is the recent debt restructuring. To avoid a potential bankruptcy cliff, Beyond Meat finalized a debt exchange for its 2027 notes. The cost of this survival was staggering. The company is issuing up to 326.2 million new shares of common stock. To put that in perspective, this single move has increased the total number of shares outstanding by over 500%. This isn't just dilution, it's a deluge. It's a 5-to-1 reverse split in terms of your ownership stake. Every share you held now represents a dramatically smaller piece of the pie. This is why an investment of $1,000 in this company just 5 years ago is now worth, according to recent reports, less than $8. The company's stock structure has been fundamentally broken and rewritten. This is the reality that challenges the meme stock squeeze narrative. The company saved itself from insolvency, but it did so by flooding the market with paper and decimating the value of its existing equity. The stock is not just down, its entire valuation has been reset. This brings us to the short-selling activity, which has always been central to the Beyond Meat story. This is a critical area where expectation and reality are dangerously disconnected right now. Many retail investors look at public short data and might be confused. Some data feeds are showing the short float percentage has collapsed, dropping from an astronomical 63% just in late September to a seemingly mundane 14 or 15% as of mid-October. The expectation, therefore, is that the shorts have covered, that the squeeze is over, and the bears have gone home. This could not be more wrong. This is a statistical illusion, and it's a perfect example of why investors need to look deeper. The short float percentage dropped not because short sellers bought back shares, but because the float itself, the denominator in the equation, exploded by over 500% due to that debt deal. Let's look at the hard numbers, which are the only reality that matters. At the end of September, there were about 39.6 million shares held short. By mid-October, after the dilution, that number had increased to 51.8 million shares. The bears did not cover. They added to their positions. They are pressing their bets. The percentage looks smaller only because the total number of shares is now monstrously large. Famous short sellers like Jim Chanos have been public about their position, noting that even at these low prices, the company is trading at a high multiple of its sales, a valuation he called priced for perfection for a business that is anything but. The days to cover metric has also collapsed, from more than 10 days to less than 5, or in some cases, under 1. This again is not a bullish sign. It's a reflection of the massive new float and high trading volume. What's your take on the short interest data? Is the 14% float a misleading number, or do you think the bears are trapped? For any investor, the actionable step here is clear. You must look beyond the short float percentage headline, especially after a dilution event. You must check the absolute number of shares held short, which is available on exchange websites, and compare it to the new, much larger figure for total shares outstanding. In this case, it reveals the bears are more entrenched than ever. So, what is Beyond Meat fundamentally? This was a company that went public in 2019 as a high-growth tech disruptor. It wasn't a food company, it was a food tech company, a new way of making protein. The business model was to partner with major food service chains like McDonald's, Yum Brands, and Starbucks, while simultaneously capturing massive retail shelf space. For a while, it worked. The brand was powerful and enthusiasm was high. But that enthusiasm has faded. The core problem, as Wall Street analysts have pointed out, is that Beyond Meat does not have a durable competitive advantage or a moat. It turns out plant-based meat is essentially a commodity. The company is now fighting a brutal war on two fronts. On one side, it has its direct competitor, Impossible Foods, which remains private and is also fighting for the same restaurant contracts and shelf space. On the other side, it has the legacy food giants, companies like Tyson, Hormel, and Kellogg's through its Morningstar brand, who have deep pockets, massive distribution networks, and their own plant-based products. And perhaps most dangerous of all are the generic private label store brands, which offer a similar product for a much lower price. This is a death sentence for a premium brand. Consumers are trading down. They are not willing to pay a significant premium for a plant-based burger when their grocery bills are already skyrocketing. The numbers prove it. In the second quarter, Beyond's U.S. retail volume plummeted by 24.2%. The company is trying to win back customers with its new Beyond Burger IV, which it touts as having a cleaner label with avocado oil. The new partnerships with Hard Rock Cafe and Erewhon are part of this push. But these are small-scale, high-end outlets. They are not going to move the needle in a way that offsets the volume collapsing at major grocery chains. This is why Wall Street is almost universally bearish. There's not a single buy rating on this stock from a major analyst. Mizuho recently reiterated its underperform rating with a 1.50 price target. TD Cowen is even more bearish, maintaining a sell rating with a price target of just 80 cents, which is below the current share price. These analysts see a company with declining sales, negative gross margins, persistent cash burn, and a management team that just delayed earnings to announce a major write-down. This puts the future outlook into stark relief. The bull case, which is a very narrow path, is that the company has just completed a kitchen sink quarter. The idea is that the impairment charge, the exit from China, and the massive dilution are all part of a painful but necessary reset. By cleaning up the balance sheet and getting the debt off the books, new management or even the current CEO, Ethan Brown, can now focus on stabilizing the core business. The hope is that the new burger formulation regains consumer interest, the commodity inflation that hurt their margins subsides, and the new smaller partnerships with Hard Rock and Walmart can slowly build into something meaningful. In this scenario, the stock, now at 1.18, is a speculative bet on a long-term turnaround. The bear case is far simpler and, based on the data, more probable. The company is in survival mode, not growth mode. The
The 500% dilution was not a strategic reset, it was a desperate move to stave off bankruptcy that wiped out shareholders in the process. The material impairment charge is just the next shoe to drop, confirming that the company's assets and past investments are not worth their stated value. The competition is not letting up, and consumer demand for the category remains weak. The company continues to burn cash it does not have, and its path to profitability is non-existent. In this scenario, the 52-week low of 50 cents is not a floor, but the next logical target. The company has become a zombie stock, technically alive, but with no real prospects, kept afloat by a large base of retail investors who are holding on to the memory of what the stock once was. This is the ultimate tension for Beyond Meat. The expectation, fueled by its meme stock status and past glory, is that it's a coiled spring ready for a squeeze.